What Warren Buffett knows that makes him prepare for an economic crash is not a secret message from the future. It's a simple, battlefield-tested set of principles about how shocks move markets and how to position capital so you survive the storm and buy assets at fire sale prices afterward. Look at what he's been doing with Berkshire Hathaway over the past several years, and you can read the playbook. Build insurance capacity, own energy and industrial exposure, pile up liquid short-term assets, and reduce commitments to businesses that break when trade and rates go wrong. That pattern doesn't prove prescience about any specific geopolitical event. It does, however, reveal a coherent strategy for a world in which wars, choke points, and supply shocks turn into inflation, rate hikes, and distress selling. That's what I want to show you today. Ask yourself, why would one of the most capital-heavy investors on Earth intentionally hold enormous cash, boost insurance underwriting capacity, buy into energy producers, and trim exposure to airlines and logistics-dependent tech? What does that combination prepare him for? The short answer: a shock that drives commodity prices higher, raises the cost of moving goods, inflates consumer prices, forces central banks to tighten, and reprices long-duration assets. In plain terms, crisis-driven inflation and a messy repricing of risk. If this thesis resonates, I've put together a free preview that lists 5 types of stocks and sectors that tend to perform in this setup. Grab that free preview in the description below. It's a short checklist you can keep on hand during volatile days. Let's set the scene with a concrete catalyst so the mechanics are clear. Imagine a regional war centered on the oil-producing waters and the shipping lanes that carry a large share of global trade. Think of a serious confrontation that disrupts traffic through the Strait of Hormuz or the Red Sea. When a choke point like that is threatened, the immediate visible market reaction is almost always the same. Oil spikes, freight rate surge, insurance and rerouting costs climb, and global supply chains strain. That's the price shock. Higher oil and shipping costs ripple quickly into headline inflation. Manufacturers face rising input and transport costs. Retailers either swallow margins or pass price increases to consumers. When inflation ticks up, central banks, especially the Federal Reserve, are expected to respond by raising short-term interest rates to take the heat out of the economy. Higher rates compress the present value of future cash flows, and that's technical language for long-duration assets. Think long-term bonds and many growth stocks get hit hard. At the same time, insurance companies see 2 effects. Premiums rise because perceived risk rises, but so does the potential payout on claims. If a large insurer has the underwriting capacity and balance sheet discipline, it can profit from higher premiums and selectively underwrite risk at better margins. Similarly, energy producers immediately benefit from higher commodity prices. Defense and industrial suppliers often see increased demand and a political willingness to accelerate spending. Cash, meanwhile, becomes a weapon. When prices fall after panic, someone with dry powder can buy quality assets at discounts. Now let's look at the evidence, move by move. Take the past several years as a timeline and read the pattern, not the headline noise. First, energy exposure. Across multiple reports and filings, Berkshire has materially increased its exposure to energy producers and midstream assets. Whether through direct stakes in oil and gas companies, increased investments in refineries and pipelines, or acquiring stakes in large producers, this tilt is a clear hedge against commodity shocks. Energy assets are one of the most straightforward ways to protect against and profit from rising oil prices. Why? Because higher commodity prices flow directly to the producer's revenues and cash flows. Second, insurance capacity. Berkshire has consistently emphasized insurance businesses, both primary insurers and reinsurance operations, as a core part of its strategy. Insurance is capital-intensive but generates float. Premiums collected today that can be invested until claims are paid. In a crisis that raises both premiums and underwriting margins, a disciplined insurer with spare capacity can underwrite at attractive rates and invest the float in short-term instruments or opportunistic equity purchases when markets are beaten down. That capacity to wield float and deploy capital fast is a distinct advantage when volatility spikes. Third, industrial and defense-related holdings. Berkshire has increased exposure to precision industrial suppliers and defense-adjacent companies, the kind of firms that make quality components for heavy machinery, aerospace, and infrastructure. In a geopolitical shock that prompts higher defense spending or supply chain reshoring, those firms are well positioned to see orders accelerate. They're also often less dependent on razor-thin retail margins and more dependent on contracts and specialized capabilities, which makes their cash flows stickier in turmoil. Fourth, a deliberate dialing back of highly logistics-dependent and interest rate-sensitive exposures. Airlines, global shipping-dependent retailers, and technology companies with business models that hinge on low-cost globalization are more exposed when freight costs and insurance premiums surge. Banks sitting on long-duration, low-yield bonds also become vulnerable when interest rates rise. Those bond portfolios lose market value and can stress bank capital ratios. Reducing exposure to these categories lowers sensitivity to the immediate shock and to the subsequent policy tightening. Fifth, massive liquidity parked in short-term treasuries and cash equivalents. Berkshire is reported to be sitting on a very large cash pile, much of it in short-term government paper. That cash does not promise returns while sitting idle, but in the middle of a crash it's the ultimate optionality, the ability to buy high-quality assets at a discount without being forced sellers. If prices fall, a buyer with cash can be both a lifeline for a distressed seller and a long-term winner by purchasing durable businesses cheaply. That optionality is central to the strategy. Put together, each piece makes sense in the same direction. Energy hedges for commodity inflation. Insurance and reinsurance provide underwriting leverage and float. Industrials and defense capture demand inflections. Liquidity grants optionality. And trimming airlines, logistics exposed tech, and long-duration bond exposure reduces the portfolio's sensitivity to the mechanics that turn a regional war into a broader economic crash. But how exactly does a regional war translate step by step into a larger market crash? Here's the mechanism in a straight line so you can see the cause and effect. Step 1. Supply disruption. A choke point threatened or closed reduces global flows of oil and other goods. Producers may curtail exports, and tankers take longer routes to avoid danger. Step 2. Price reaction. Less supply plus the same or higher demand equals higher oil prices. Shipping also becomes more expensive as carriers reroute and insurance costs spike. Step 3. Input inflation. Higher commodity and transport costs feed through to consumer prices. Manufacturers face higher input costs. Retailers face higher freight bills. Step 4. Policy reaction. Central banks, seeing stubbornly higher inflation, raise short-term interest rates to slow demand. The Fed's tightening cycle increases borrowing costs across the economy. Step 5. Asset repricing. Higher rates reduce the present value of future profits, hitting long-duration assets like growth stocks and long-term bonds. Banks with sizable holdings of low-yield, long-duration bonds see the market value of those assets decline, which can strain capital ratios and lending capacity. Step 6. Forced selling and fire sales. Margin calls, liquidity shortages, and balance sheet stress lead some institutions to sell quality assets to meet obligations. That's when a buyer with ready cash can pick up assets at steep discounts. Step 7. Recovery and redeployment. After the initial panic, investors who bought at distressed prices capture outsized returns as markets normalize and policy stabilizes. Who wins in this chain? Energy producers, because commodity prices lift revenues, insurers with underwriting capacity, because premiums and margins rise, defense and precision industrial suppliers, because demand and government spending can increase, and cash holders because they can buy quality assets at lower prices. Who loses? Airlines and shipping companies face higher fuel and rerouting costs. Logistics-heavy retailers and tech firms see margin compression. Banks with long-duration, low-yield securities on their balance sheets face valuation losses and potential liquidity stress. And low-margin manufacturers squeeze between higher input costs and limited pricing power. This pattern explains why Buffett's set of moves, energy, insurance, cash, industrials, and selective divestments, fit together. They're not random purchases. They collectively reduce vulnerability to the chain of events above and increase optionality to capitalize on the aftermath. So, how do you translate Buffett's approach into a practical framework for your own thinking? I'm not saying you should copy his trades or expect identical results. I am saying that his positioning reveals tactical principles that can be studied and adapted. Here are 5 principles to adopt as mental models when the market starts to smell like trouble. 1. Prioritize liquidity and optionality. Cash is a weapon in crises. Holding a meaningful allocation to cash and very short-term government instruments reduces the chance you're forced to sell at bad prices. It also lets you act decisively when discounts appear. The target allocation depends on your risk tolerance, time horizon, and liabilities. But the concept is universal. Liquidity equals optionality during panic. 2. Own underwriting capacity or invest in firms that control pricing power in crisis environments. Insurance businesses, reinsurance, and other companies that can capture higher prices when risk rises are structural advantages. They can write policies at superior rates and invest the float until claims are paid. Look for disciplined balance sheets and conservative underwriting standards. 3. Tilt toward real asset exposure that benefits from commodity inflation. Energy producers, certain materials firms, and infrastructure operators often see cash flows rise with commodity prices. These sectors also provide natural hedges against inflation. 4. Reduce exposure to long-duration, rate-sensitive instruments when policy tightening risk is elevated. That doesn't mean avoiding bonds entirely, but be mindful of duration. Shorten maturities or favor floating rate structures where appropriate. For equities, consider the sensitivity of cash flows to higher discount rates. 5. Be ready to deploy capital into distressed but fundamentally sound businesses. The hard part is resisting the urge to chase every beaten-down name. The smart part is having criteria to identify firms with durable competitive advantages, strong balance sheets, or the potential to be restructured, and competent management. Have a checklist and cash reserved for those moments. Those 5 principles become a playbook. Preserve optionality, own pricing power, favor real asset hedges, manage duration risk, and prepare to pick up bargains. Of course, every strategy faces risks and caveats. Markets are messy, and history doesn't repeat exactly. Geopolitical shocks can be shorter or longer than expected, and policy responses can vary. Sometimes central banks move faster than markets expect. Sometimes they move too slowly. Insurance businesses, while attractive in theory, are still vulnerable to catastrophic losses if mispriced risks accumulate. Energy investments carry their own operational, regulatory, and transition risks. And liquidity has an opportunity cost. Cash that sits idle foregone returns in rising markets. So, a few short practical cautions. Never assume a single factor will drive outcomes. Stress test your assumptions across multiple scenarios. Size positions, so a single trade doesn't imperil your entire portfolio, and verify any specific numbers or company names before making a trade. For transparency, this analysis is educational and historical in nature and is not personalized financial advice. Now let's put this into the payoff mechanics. How does someone like Buffett actually make money from these moves when a crash arrives? First, insurance float. When premiums rise, disciplined insurers improve underwriting margins. If you collect premiums today and invest them for even a short period, you generate incremental returns. In a crisis, investors often sell equities indiscriminately, dropping prices below intrinsic value. An insurer with float can allocate that capital to buy equities at favorable prices, compounding returns later. Second, buying energy cash flows at the top of the cycle and then benefiting from higher prices during the shock is straightforward. Energy producers often have contracts, reserves, or infrastructure that scale cash flow as prices rise. Owning production capacity during a shock is like owning a toll bridge when traffic spikes. Third, industrial and defense suppliers can ride a different clock. Defense budgets and reshoring initiatives tend to accelerate after clear supply vulnerabilities are exposed. Companies that make specialized components or own critical manufacturing capabilities can see multi-year order backlogs and pricing power. Fourth, liquidity-driven buying. When banks or leveraged entities face margin calls, quality assets trade at discounts because sellers are pressured. A buyer with cash can negotiate better terms, potentially taking minority or controlling stakes. Over time, those assets recover a large portion of lost value, delivering outsized returns. If you step back, the cumulative effect is both defensive and opportunistic. You shield downside through balance sheet strength and shorter duration assets, and you capture upside by acquiring fundamentally sound businesses at distressed prices. Let me be explicit about limits. Nothing here is a promise. Positioning like Buffett is not a guarantee of profit, You cannot assume he had inside knowledge of any particular geopolitical event. The moves suggest a strategy for systemic risk, not clairvoyance. Specific company names, transaction sizes, and exact cash figures that circulate in headlines should be verified independently before you take action. Reported cash piles in large investment vehicles are sometimes described as roughly $400 billion in short-term treasuries. That's a reported figure and should be checked against filings and official reports if you plan to trade based on it. If you want to study this approach step by step, I've built a practical investing academy that walks through how to size liquidity, identify insurers and energy names worth researching, construct short-duration bond allocations, and build a checklist for buying distressed but high-quality businesses. The Academy includes detailed case studies and a model portfolio framework. Again, for educational purposes and not personal financial advice. To close, answer the title plainly. What Warren Buffett knows that makes him prepare for an economic crash is not a secret about a single event. He recognizes the pattern. Shocks that disrupt supply chains and commodities create inflationary pressure, force central banks to act, and repricing of long-duration assets leads to distress selling. His moves, bolstering insurance, increasing exposure to energy and industrials, hoarding liquidity, and trimming rate and logistics-sensitive positions, are a coherent, repeatable response to that pattern. They are about optionality, underwriting leverage, and the ability to act when fear drives prices below intrinsic value. If you want the detailed checklist and the 5 types of stocks that typically outperform in this scenario, enroll in the Investing Academy using the link in the description. The course lays out the exact framework I just described, templates for sizing liquidity, and a walkthrough of how to research candidates in each category. Again, this is educational material, not individualized financial advice, and past positioning does not guarantee future returns. Markets change, surprises happen, and no single investor holds all the answers. But if you learn to see the chain reaction, supply shock to inflation, to rate hikes, to asset repricing, you can design a portfolio that is less vulnerable to panic and better positioned to buy quality at a discount when others are forced to sell. That's the practical insight Buffett's recent allocations reveal.